Hello and welcome to another video from howtooffice.com. Today we'll be covering Microsoft Excel 2010 training, how to plan payments and savings. The contents for today are use of financial functions in Excel 2010. This will include 7 instructional movies and tips. At the end, we'll go over everything with a quick reference card. Okay, let's begin. The use of financial functions will have you learn how to figure out payments and savings by using formulas in Excel. This course explains how to calculate mortgage and down payments, save for a vacation, and calculate how much your savings will grow over a period of time. The first thing that we'll be looking at is to figure out the monthly payments to pay off a credit card debt. In this example, we'll be calculating the payment needed each month to pay off a $5,400 credit card debt over a period of 2 years. In order to do this, we'll go ahead and click our cell, and then we can go to the FX button or Formula button. This will open up the Insert Function dialog. Here, we can type in monthly payments. And here you can see the one of the formulas available is PMT. That's what we'll be using today. So we can go ahead and click that and then say OK. Next we'll see the function arguments dialog box, which will detail each function and give a definition if needed. The rate is going to be the interest rate of the credit card. For this, it'll be 15%. We want to divide that by 12 for the number of months in a year. The MPER is the total number of payments for the loan. Since this is going to be a 2-year period that we pay this off, we'll do 12 times 2 to get the number of months in a 2-year period. The last argument that we'll be using to calculate this is the PV, or the present value. This is the total amount that a series of future payments is worth now. In our case, it's going to be the amount of debt that we have on the credit card, or $5,400. We'll hit OK, and you can see that we have a negative balance of $261.83. That is the payment for each month over a 2-year period of time with an interest rate of 15% that will allow us to pay off the $5,400 debt. Now, if we wanted to change the yearly amount and change it to a 4-year period as opposed to a 2, we can go to our MPER argument and change the times 2 to times 4. There we have 12 months times 4 is 4 years, and we can see that it lowers our payment to $150.29. However, just be aware that over a longer period of time, you are paying more towards interest, so the difference there will be quite significant in the amount of interest paid towards the bill. Next, we'll figure out the monthly mortgage payments for a house that we are going to purchase. In this example, I have found a house that is $180,000. And I want to determine what my monthly payment over a 30-year mortgage will be for that house. In order to calculate this, we'll use the same formula, the PMT or payment formula. However, I'll enter it in a different way. As opposed to going to the formulas or FX button, I'll type in equals PMT, and then I can double click on the PMT as it shows here in Excel. Notice that it capitalizes and enters a parenthesis for me. Also, it will show each argument as needed for the formula. Our first is going to be our rate. For the house, we have acquired a 4% interest rate. I'll put my 4% divided by 12 and a comma so I can go into my next argument, which is the MPER. Here, this is going to be a 30-year fixed mortgage, so we'll put the 30 times 12 to calculate needed for our 30-year payment. Lastly, we'll put the argument for the present value is $180,000. I'll put an in parenthesis, and you can see that our total payment for a $180,000 house over a 30-year period with a 5% fixed interest is going to be $859.35 per month. Okay, now that is a little bit out of my budget, so I actually need to find something that is going to be much cheaper per month. I'm looking for something about $700 per month. So the next calculation that we're going to do is going to be based off our payment, and then we'll determine how much of house we can afford. To show you an example, we'll go ahead and hit the FX button again, and here we'll just type in payments. Now you can see the PV formula returns the present value of an investment, the total amount that a series of future payments is worth from now. We'll go ahead and use the PV. The rate is going to be our 4%. The MPER is going to be, again, 30 times 12 because it's still going to be a 30-year loan. And the payment that we're going to enter in is what we want to pay per month. So I'm going to put in -700. The reason that I put a minus or a negative sign before the payment is anytime that you are entering a payment into the formulas here, you want to put a negative or minus sign in front of them. Here, we'll hit OK. And you can see the maximum house value that I can afford is $146,622.87. Now I'll have to go back to the real estate agent and look for a house within my budget. Next, we'll need to find out how much to save each month for a dream vacation. I have planned a dream vacation for my family, and with all family members included, all expenses included, I've determined that it will cost $9,000 that I'll need to save, and I'm giving myself 3 years to do so. So we'll need to calculate how much each month I'll need to save over a 3-year period of time to equal my $9,000. This is starting from zero, so my account that I'm starting with has $0. To find this out, we'll use the PMT. Our rate is going to be 1.5, or the interest that I receive from the bank on my account, divided by 12. The MPER is going to be 3 for a 3-year period. The present value is going to be 0 since I'm starting with $0 in my account. And my future value is going to be $9,000 because that is what I'm saving towards. And the result, as you can see, is $244.57 that I'll need to stow away each month over a 3-year period of time to save up $9,000 for my vacation. A variation of this is if we are starting with an initial deposit in the account. Let's say that I start out by putting $1,000 into the account, and I want to calculate how much each month I'll have to put in over a 3-year period of time to equal $9,000. With the same formula, PMT, my same bank rate, which is 1.5%. I'll use the same NPER, but for the present value, I'll put in 1,000 because I've put in 1,000 in that bank account. The future value will be 9,000 because I'm going towards 9,000. Remember to put a negative sign in front of the payment or the amount that's already there. And you can see that I have lowered my payments by making an initial investment of $1,000 to $216.15 a month over a 3-year period of time. For our next example, we'll find out how long it will take to pay off a personal loan. Here, I have a personal loan of $3,000 with a 4% interest rate. I have budgeted $150 a month to go towards that loan. My goal today is to find out how many months it will take to pay off that loan at a rate of $150 a month with a 4% interest rate. To do this, we'll use the NPER function. I'll type in equals NPER with an open parenthesis. The rate is going to be my 4%. So 4% divided by 12. My payment is going to be negative $150. My present value is going to be $3,000 for the amount of the loan. I'll use a close parenthesis and hit enter. And you can see that it's showing just over 20 months to pay off that amount. Since we are over the 20, we'll need to round up to 21. So I'll need to slightly change my calculation to figure in for 21 months as opposed to 20 to figure out what my actual payment will be. In order to do this, we'll use the PMT function, my rate of 4%, my NPER is going to be 21 months, and my present value is going to be $3,000. I'll I'll use a close parenthesis and hit enter, and you can see my budget from $150 has slightly dropped to $148.15 per month over a 21-month period of time. In this next example, we'll be figuring out how much of a down payment we'll need to make. For this example, let's say that we're buying a car. The value of the car is at $20,000. In order to figure out how much of down payment that I want to make to be able to make a payment of $350 a month, I'll need to do some calculating. First, we start by, in our cell, hitting equal, and then we'll need to put the value of the loan. This is $20,000. We're going to be subtracting from that amount the PV, or present value. To calculate this, we do 20,000 minus PV, open parenthesis. The rate is going to be my 4% divided by 12. The NPER is going to be the 3-year period, so 3 times 12. And then the PMT, or the payment, is going to be minus $350 for the $350 a month payment that I'm looking to achieve. If we use a close parenthesis and then hit enter, you can see that I would need to make a down payment of $8,145.23 to reach my goal of a $350 payment over a 3-year period of time for a $20,000 loan. Next, we'll see how much your savings will add up over a period of time. For this one, what we're looking to do is find out how much our account will have after putting in the same amount of money over a given period of time. In this case, we're going to use the equals FV for future value. The rate that we're going to have is 1.5% for the bank account, divided by 12 as always, a comma. And the PMT, or the NPER, is the next argument. We want to calculate for 10 months, so I'll just put 10 in there. And the PMT is going to be the amount that we're paying there every month. For this, I'm going to put minus $250 because I'm going to be depositing $250 to the account every month for 10 months. If we hit enter, you can see that after 10 months, our account will have $2,514. Now what we want to do is figure that out if we already have a particular amount of money in the account. We'll use the FV function again. The rate is going to remain the same at 1.5%. The NPER is going to remain the same at 10 months. The payment is also going to remain the same at negative $250. Now we go into the present value. Let's say that we already have $1,000 in the account. So we'll go ahead and put that in there as minus 1,000. We'll put a closed parenthesis and then hit enter. There you can see that our total amount after 10 months will be $3,526.68. If we wanted to change the amount of time that we're depositing the funds from 10 months to, let's say, 2 years, we could go into the formula and adjust the NPER value from 10 to be 12 times 2, or 24 months. There you can see it's changed our value to $7,117.48. Now that we've completed our formulas and you can see how we've calculated everything, let's take a look at the quick reference cards. We covered how to enter functions into formulas. We used both the Formulas tab or hitting in the equals sign to enter in our formula. Use the Function Arguments dialog box to see definitions of your formulas and to get a better idea of what each one does. We paid off a credit card by determining the balance and what we needed to pay each month over a period of time. The formula we used for this was PMT. The result is a monthly payment of $266 at 17% over 2 years. The rate argument is the interest rate per period of the loan. For example, in this formula, 17% was the annual interest rate is divided by 12, the number of months in a year. The NPER argument of 2 times 12 is the total number of payment periods in the loan. 2 times 12 would be 2 years or 24 months. And lastly, the PV, or present value of the argument, was the amount of the debt at $5,400. We figured out the monthly mortgage payments in a house worth $180,000. We used the PMT formula again. The rate argument was 5% divided by 12. The NPER was 30 years times 12. The PV argument was the amount of the house at $180,000. We figured out how much to save for a vacation. Again, we used the PMT formula with the rate at 1.5, a 3-year period. We used 0 for the present value since we did not have any funds in our account, and the future value, or the value that we were trying to achieve, was set to $8,500. We also showed an example how to figure out how much a house you can afford to buy. For this, we used the PV function. The formula is a result as an affordable house that would cost us a little over $149,000. The rate argument was 5%. The NPER was 30-year for a fixed mortgage. The PMT was negative $800, or the amount that we were looking to pay each month. We figured out a down payment for a car worth $19,000. For this, we used the value of the car or loan at $19,000 and subtracted the present value, or the PV, to figure out what our down payment would be to reach a monthly payment of $350. The rate that we used in this formula above is 2.9%. The NPER was 3 times 12 for a 3-year period. The payment that we wanted was negative $350 to achieve a $350 per month payment. We also figured out how long it would take to pay off a personal loan. In this example, we have a $2,500 loan. We wanted to pay towards $150 a month at a 3% annual interest rate. The NPER function helped us achieve this calculation with the rate of 3%. The payment argument is negative $150 for our payment. The present value was $2,500. And because the payment period doesn't come out of an amount even, you want to make sure that you round up. Doing this slightly adjusted our 150 down to 148. Another example that we saw was to see how much your savings will add up over a period of time. We started with money in our account and determined how much we will have in our account after a 10-month period of time if we made a particular number of investments at a 1.5% interest rate. For this, we used the future value, or FV formula. The rate of the argument was 1.5 for the percentage. The NPER was 10 months for a period of time, and the payment that we made was $200 each month. The present value of the argument was what we already had in the account, or a deposit of negative $500. That's it for the examples in the training today. Hopefully we covered a wide range of payment calculations that will help you calculate either a car, house, personal loan, or other types of savings or plannings. All these formulas are available in Excel 2010. You can find more information by visiting www.how-to-office.com. Thanks for watching.